I came across the use of a phrase today, no news is good news. And with that, for now, international tensions are easing somewhat. What's your view on the current market picture? Because we know that that news flow doesn't stay away too long.
Good morning, Alishia. Yeah, I think we've had so much volatility over the last couple of weeks that it's most welcome to see markets settling down. But I think the bottom line here is that the markets are a little bit more encouraged on two fronts. One is, of course, there's a lot of expectations that central bankers will come up with some kind of a silver bullet, if you like, for this ailing global economy on Friday when they meet in the States at the Jackson Hole meeting. And then finally, we've got this oil price which is retreating on the back of those geopolitical tensions easing excuse me, in Libya. So on both fronts, the oil as well as the potential further monetary stimulus coming out of the States is what's, I think, fueling a bit of the stability.
Of course, we've got that focus on what's going to emanate out of that Jackson Hole meeting on Friday specifically. Your broad expectations there, because the market's saying that we shouldn't be setting up ourselves for disappointment.
Yeah, I think there's definitely a risk of that because, if we look at things like inflation in the States, it is trending higher, and we might not see these central bankers actually jumping off with some more monetary stimulus, especially if you consider that the previous two quantitative easing measures haven't really achieved the desired results. If one thinks that demand is still relatively weak, unemployment still relatively high, so they might look for alternative measures. And yes, I think if the market is holding out for too much stimulus, they could very well be disappointed.
And while we've got the markets holding their breaths on that front, more immediate and pertaining to today, we've got traders awaiting that flash PMI data out of Germany, France and the Eurozone as well. Of course, a weak number there is likely to exacerbate fears about the region as a whole. So your expectations there, because we've certainly seen some encouraging number come through from China this morning.
Yeah, I think you hit the nail on the head there. I think that's where the focus is today. What comes out of those manufacturing data will provide the latest kind of update with regards to this dreary global outlook that we find ourselves facing. Of course, if the numbers disappoint, then I think risk aversion is going to come back without doubt, and vice versa. So we're hoping that numbers will impress, but I'm not holding my breath for a good number. We've just seen so much disappointing figures coming out of both the US and Europe, and I just don't think this is going to be any different.
And, in anticipation of that, I mean, where the euro is likely to come under pressure if that scenario does play itself out, I mean, what are you thinking about all the rhetoric we're hearing around Swiss and Japanese authorities and intervention from their end to weaken their currencies? Because I asked one of the commentators at the desk yesterday, and I'm going to pose the question to you. Does it surprise you the kind of reaction we see where, any intervention that we do see, the implications are so short-lived?
I think that's exactly it. I think they are proved to be very short-lived. I don't think intervention is a sustainable game, to be plain. We've seen it on a number of fronts with big central banks like Japan with a lot of ammunition, Switzerland as well. They come to the market, try and deter a little bit of appreciation, but they can't carry on for long periods of time. If the market wants to push a currency in a specific direction, I'm afraid that's where it's probably going to go, and you just really you're raising a red flag to a bull by intervening. They're just probably going to go for you even harder. So I think it's an expensive exercise. There's an opportunity cost, of course, always associated with the reserve accumulation or any other kind of intervention. So bottom line is I think they can do it short term, try and surprise the market, but it's not sustainable, no.
This morning, Reserve Bank Governor John Marcus saying that the global economic crisis cannot be resolved by monetary policy alone. And speaking at the American Chamber of Commerce meeting, saying that monetary policy, however, can help to some extent. So how should we be using that as a tool more effectively, in your opinion, Michael?
Well, I think it's a balancing act, as normally is the case. Obviously, we're living in an environment where interest rates are low by historical standards, and there's been a lot of monetary stimulus. We need to see, of course, the fiscal side also playing its hand, and that's very difficult. That's what's the catch-22 here, because a lot of these countries are so heavily indebted already on the sovereign side that they've got to cut back on spending and raise taxes. And you know, this is the time when you actually need to be rolling out with the government firing power, so to speak. And I think that's what we've seen in South Africa, which has been very nice to see, in that during the good years we were storing a lot of those extra revenues, building up and taking advantage of all those tax receipts. And sure, our deficit or our fiscal balance is moving into deficit territory, but we have the ammunition, we have the ability to go to market, to raise debt now when we need it, to try and stimulate demand. So I think South Africa is one of the few countries that's fairly well placed to have that dual effect of monetary accommodation as well as fiscal stimulus.